At some point in your passive investing journey, you shift from thinking about individual deals to thinking about a portfolio. That shift is important. Because the questions change. You stop asking, is this a good deal, and start asking, does this deal fit what I'm building? In this video I'm going to walk through how to think about a passive income portfolio, what diversification actually means for LP investors, how to sequence your investments over time, and what a well-constructed passive portfolio looks like at the 3, 5, and 10-year marks. First, let me make the case for portfolio thinking. Any single deal can underperform. Markets shift. Operators make mistakes. Rate cycles move. A deal that looked well underwritten 2 years ago can face headwinds that weren't in the pro forma. If your entire passive investment capital is in one deal, or with one operator, a single bad outcome has an outsized impact on your wealth. A portfolio approach doesn't eliminate risk. It spreads it across uncorrelated variables, different operators, different markets, different asset classes, different hold periods. When one deal is in a difficult quarter, the others continue to perform. This is not complicated portfolio theory. It's the same logic that makes index funds better than single stock bets. There are 3 dimensions of diversification for LP investors. Dimension 1, operator diversification. This is the most important. Operator risk is the single largest variable in whether a syndication delivers its projected returns. GP communication, underwriting discipline, renovation execution, these are operator-specific risks. Having capital with 2 or 3 operators you vetted independently is materially safer than having all capital with one operator, even a very good one. Target, by your 3rd or 4th investment, have capital with at least 2 different operators. Dimension 2, geographic diversification. Real estate is local. A market with strong job growth, population inflow, and limited housing supply performs differently than one facing outmigration or oversupply. If all your deals are in one metropolitan area, you're exposed to that market-specific cycle. A single market event, a major employer leaving, a zoning change, a shift in migration patterns, affects all your investments simultaneously. Geographic diversification doesn't mean spreading randomly across the map. It means being intentional about what markets you have exposure to, and whether they're correlated. Texas and Southeast Sunbelt markets have moved together in recent years. If you have 5 deals in Dallas, Austin, Nashville, and Charlotte, you're more diversified than 5 deals in Dallas, but you're still exposed to a correlated macro trend. True geographic diversification includes exposure to markets with different demand drivers, a logistics hub, a major university city, a coastal market, a Midwest manufacturing metro. Dimension 3, deal type and hold period diversification. Not all deals have the same timeline. A heavy value-add deal with an 18-month renovation is a very different hold than a stabilized core plus deal with a 7-year projected hold. If all your capital is in deals with similar timelines, distributions and exits cluster, you might receive nothing for 3 years and then get 3 large distributions in 1 year. Sequencing investments across different timelines smooths your income and prevents capital concentration at exit. Also diversify by deal type, some value add for upside, some stabilized for current income, some development if you have higher risk tolerance and a longer horizon. Here's how to sequence a passive income portfolio build over time. Year 1 through 2, 1 to 2 deals. Your first investments are your education. Invest the minimum or near it. Focus on quality of operator over maximizing capital deployed. Evaluate everything: communication, reporting, distribution timeline, how the GP handles a difficult question. Year 3 through 4, 2 to 3 additional deals. Now you have a track record of your own. You know which GPs communicate well. You've received at least 1K1 and understand the tax mechanics. You can size up with a GP you've tested. Add a 2nd or 3rd operator. Diversify geographically. Year 5 through 7, you're now actively managing a portfolio. Some early deals may have exited, Reinvest those proceeds into the next round of deals with better operator selection informed by your experience. Add a new asset class if the operator's track record justifies it. Year 8 and beyond, you have enough invested history to see full cycles. You know which operators delivered. You know which deals were marketed better than they performed. You're making capital allocation decisions from a position of experience, not just analysis. What does a target allocation look like? There's no single right answer. But a framework. 60 to 70% of passive real estate capital, core LP investments with established operators, moderate risk value-add deals, asset classes you've personally evaluated. 20 to 30%, growth allocation, operators you're building a track record with, newer asset classes, more complex execution risk, development deals if you have the risk tolerance. 0 to 10%, speculative or opportunistic, early-stage operators, distressed acquisitions, high-complexity deals. Only if you can absorb a loss on this tranche without affecting your broader plan. This isn't a fixed framework. Adjust it based on your overall liquidity, your W-2 income security, your timeline to financial independence, and your tax situation. The passive income math. Let's model what this looks like in dollar terms. Assume you're deploying $25,000 into LP investments per year. In year 1, you put $25,000 into one deal. Year 2, another $25,000. Year 3, $35,000, reinvesting some early distributions. By year 5, roughly $125,000 deployed. At an average 8% annual cash-on-cash return, you're generating approximately $10,000 per year in passive distributions, before any equity at exit. By year 10, if you've maintained that pace and reinvested strategically, you could have $400,000 or more deployed. At 8% cash-on-cash, $32,000 per year in distributions. Plus equity upside at exits. At $25,000 per year deployment, year 10 passive income isn't quit-your-job money, but it's a real income stream that compounds. Increase the annual deployment, and the math changes materially. The point isn't the specific numbers. It's that consistent, patient LP investing over a decade produces a compounding passive income base that most W-2 earners never build because they never start. What does a well-built portfolio look like at year 10? 6 to 8 active LP investments across 3 to 4 operators in 3 to 5 markets. A mix of deal types, 2 or 3 stabilized assets generating current distributions, 2 or 3 value-add deals in various stages of their hold, possibly one development investment. Annual passive distributions from distributions across the portfolio, supplementing W-2 income, funding reinvestment, or providing meaningful optionality. K1s in August every year, a CPA who knows how to handle passive loss carryforwards, and a deal file that's informed your last 3 investment decisions. And a track record of your own, as an LP. A list of operators you'd invest with again, operators you wouldn't, and deals that taught you something you couldn't have learned any other way. Here's the summary. Portfolio thinking shifts the question from, is this a good deal, to, does this fit what I'm building? 3 dimensions of LP diversification, operator, most important, geographic, and deal type and timeline. Sequence, 1 to 2 deals in years 1 and 2, add operators and markets by year 4, reinvest and optimize by year 7. Target allocation framework, 60 to 70% core, 20 to 30% growth, 0 to 10% speculative. The passive income math is not complicated. Consistent deployment, reinvestment, and time. At year 10, 6 to 8 deals, 3 to 4 operators, annual distributions that matter, and a track record that informs better decisions. The LP due diligence checklist is linked in the description. It's designed to be used on every deal you evaluate. Subscribe for the next one, our final video in this series. We're going to address the question everyone eventually asks: should you be investing in real estate right now, or wait for better conditions? Market timing versus deal selection. Thanks.